Partnership liquidations. What steps are required to record the liquidation of a partnership? The first step that you want to do is the income allocation that you would normally do for the partnership. So you want to bring the current period income or loss into the capital accounts of the partnership in accordance with the revenue sharing agreement. So you want to bring this up to date in order to ready the partnership for liquidation. Next, you want to record the sale of any non-cash assets. These will be the assets that the company will no longer need. Any loss or gain is allocated to the partners based upon the income and loss sharing agreement. Again, income and loss because losses and gains go through the income statement. After you've sold all the non-cash assets, you want to pay or settle all of the partnership liabilities. You may have had to have sold some of the non-cash assets in order to pay or settle the partnership liabilities. After these steps, usually there is either no capital deficiency, meaning that each one of the partners has a credit balance in their partnership capital balances, or there is a capital deficiency, meaning that one or more of the partners has a debit balance in his capital account. A capital deficiency on behalf of one or more of the partners will mean either the partner will pay the deficiency or the other partners will absorb the deficiency. It's one or the other. After that, then you will want to distribute any remaining cash to the partners based upon their capital balances. And we'll see what that means as we walk through this example. So first, let's look at liquidating the partnership where there is no capital deficiency. The partners will share income and loss in this example equally. After updating the partners' capital accounts for the current income or loss, the balance sheet accounts remaining will be cash, land, accounts payable, and then each one of the capital balances for each one of these partners. Here we see that our assets equal our liabilities and partnership equity. The next step is to sell the non-cash assets. In this instance, it was land. If there is a liquidation loss, the journal entry will be, we are going to be crediting the land, debiting the cash that we received. We see the cash that we received wasn't as much as the land that we were carrying on the books, therefore there's a liquidation loss. And we'll run through the scenario of what happens to the books if there's a liquidation loss. Additionally, we'll run through the scenario if there's a liquidation gain. And in this instance, we are going to credit the land, debit the cash that we received, but in this instance, we received $46,000, which was $6,000 more than the land that we were carrying on our books. So let's look through these two scenarios. In this example, the partners are sharing income and loss equally according to their agreement. So if there's a liquidation loss, we want to credit the loss. It was debited earlier, and we want to take that debit, the liquidation loss, the $3,000, and it's going to be equally shared amongst the three partners. If there's a liquidation gain, previously this was a credit balance. We debit our losses and credit our gains. So in order to zero it out, we're going to debit this gain, and we are going to allocate it equally among each of the partners, which means they each get $2,000. So paying the liabilities and updating the balances. Next, the partnership pays its liabilities. The only liability it had was an accounts payable for $20,000. They have the cash in order to pay it off, so they're going to pay off their accounts payable, and we're going to credit cash. Then we're going to update the cash account as well as the partners' equity balances to ready the balance sheet for the final distribution of cash according to the capital balances. So let's look at these two different scenarios. On the left here, we have a liquidation loss on the land. So let's walk through that. Our beginning balance of cash was $178,000. We sold the land and we got $37,000. We paid off our liabilities, and so that was a credit of $20,000. So we add up all of our debits, add up all of our credits, take the smaller from the larger, and our ending balance is $195,000. We have the liquidation loss taken against each one of the partners' balances, and so now we can see the ending capital balances for the partners for all of the each one of them all in for all three. Excuse me. Kind of turn that around a bit. All right, now let's look at the liquidation gain. Here we have the same beginning balance of cash, but instead when we sold the land we got 46,000, same payment of the accounts payable, but now we have $204,000 in our cash account. And in this instance, because we had a gain, the $2,000 has been added to the capital balance for each one of the partners. Now let's see what we have now by way of a balance sheet. So here we have the final distribution of cash will be based upon the ratios of the partners' balances, capital balances. Well, let's look at what that looks like. Well, all it means is that here we have $195,000 in cash under the loss scenario, and each one of the capital balances for each one of the partners totals to $195,000. So that's what they mean by it's going to be distributed based on the ratios of the capital balances of the partners. So what will we be doing will we be crediting cash, distributing the cash, and then each one of the partners will get their share of the cash. Here we have the gain scenario, and in that previous page that we saw earlier, the cash that we had with the gain was $204,000, and we look at each one of the partners' equity, and we see each one of their capital balances total to $204,000. So we are going to credit cash and distribute the capital to each one of the partners. Now, what happens if there is a capital deficiency? Liquidating the partnership when there is a capital deficiency. So the previous example, there was no deficiency. Each one of the partners had a credit balance. Now, let's see what happens when one of the partners has a debit balance. A capital deficiency means there's a debit balance in the partner's capital account at the point of final distribution journal entry. This debit balance could be as a result of excessive withdrawals on the behalf of the partner, reoccurring income statement losses on behalf of the partnership, and one of the reasons why it's liquidating is because it's having reoccurring losses, or liquidation losses when they go to sell all of their assets. When they divvy everything up, there is a debit balance in one of the partner's accounts. So in this instance, let's look at a balance sheet with a deficiency. We have cash of $131,000. We have two partners with a credit balance and one partner with a debit balance, and so the partnership equity is $131,000. Now, theoretically, this partner's capital balance would be on the debit side of this, but that would be in a trial balance. Never mind. Just forget I said that. All right, so here we have partner's equity. All right, so you can see your professor's human here. All right. So now let's look at this. So in this instance, Rotolo owes the partnership $3,000. So he's the one with the debit balance. Both Zachary and Plaisance are the two partners with the credit balance. They have a legal claim against Rotolo's personal assets. One or two things can happen. Rotolo can either pay the partnership the $3,000, and sometimes that will happen, but a lot of times people feel that the partnership wound up not being profitable for them, so they feel like they don't really owe it because it took money from them rather than providing money to them, not thinking about how their personal choices may have affected the partnership and may have wound up with a debit balance for him. So in some instances, they can pay the partnership and realize too that the partners, if they don't pay it, the other two partners can come against them, against their personal assets. But it's difficult to bring a claim against people and get them to give up their personal assets. So I don't know how often that happens. Or what probably happens more often than not, Rotolo doesn't pay the deficiency. But let's look and see what happens in either case, despite my musings about human frailties. All right, so the journal entry for the payment would be, if Rotolo's paying it off, is the cash will go to the partnership and Rotolo's capital will be credited. So he had a debit balance, it's going to be credited for $3,000, so now it'll zero out. Now the balance sheet. The balance sheet after the deficiency payments has been made. Now the cash has gone up from 131,000 to 134,000. We have two partners with credit balances, and those total to 134,000. And so we're going to do the final distribution according to their ratios. So Zachary will get 69,000, place on 65,000, and cash will be credited and zeroed out. Now, what happens if the partner doesn't pay the deficiency? Then the other two partners will absorb the deficiency according to the income and loss agreement. Well, the income and loss agreement had them sharing equally. So since Rotolo is out of the picture now, this means that Plaisance and Zachary will share it 1/2 and 1/2. Prior to this time, with three partners, it was 1/3 for each. Now it's a half for each. So in this instance, the partners are sharing income and losses equally. Therefore, the journal entry would be Zachary's capital is going to be debited for $1,500, which is 1/2 of the 3,000. Plaisance will get $1,500 as a debit against his capital balance. Again, his 1/2 of the deficiency of Rotolo. So now let's look at the balance sheet, what it would look like after this. So the new balance sheet would still have the same cash because Rotolo didn't infuse the partnership with the cash that he owed it. So we still have 131,000. Now Zachary's capital has gone down by 1,500, so now it's 67,500. Plaisance has gone down by 1,500, so now it's 63,500. But the two of them added together means their partner equity together is 131,000. So the distribution then will be to Zachary according to his capital balance, Plaisance according to his capital balance, and cash will be zeroed out.